December 26th, 2025. Silver just hit $74 an ounce. But here's what most people don't know. That's not the real price. Not if you're actually trying to buy physical silver in the world's largest industrial market. In Shanghai right now, silver is trading at $78.49 per ounce. That's nearly $4 higher than what you see on COMEX futures. $4. On an ounce of silver, think about that for a second. This isn't some minor arbitrage opportunity. This is a massive red flag that something fundamental has broken in the global silver market. And it's happening right now in real time as we head into 2026. Let me paint you a picture of what's really happening. While Western traders are playing around with paper contracts on COMEX, while banks are issuing forecasts that are already obsolete, while mainstream financial media talks about modest precious metals gains, the actual physical silver market is experiencing something we haven't seen since the Hunt brothers tried to corner the market in 1980. But here's the twist. This isn't being driven by a few billionaire speculators trying to get rich quick. This is being driven by factories, solar panel manufacturers, electric vehicle producers, electronics companies, real businesses that need real silver to make real products. And they're all fighting over a shrinking pool of available metal. The numbers are staggering. Shanghai Gold Exchange inventories have collapsed 18% in just 2 weeks. The Shanghai Futures Exchange? Even worse, their silver stocks plummeted 44% in that same time frame. We're talking about hundreds of tons of silver just vanishing from Chinese warehouses. To put this in perspective, Shanghai's silver inventories used to sit around 5,000 tons at their peak. Now they're hitting 10-year lows. The metal is simply disappearing into the hands of manufacturers who can't afford to wait for delivery. They need it now. Meanwhile, over in New York, COMEX is experiencing something equally dramatic. More than 60% of their registered silver stocks, that's the metal actually available for delivery, has already been claimed through December delivery notices. We're not even through the year yet, and the exchange is running dangerously low on metal that traders can actually take possession of. Here, arbitrage traders have figured out the game. They're buying cheap paper silver on COMEX, standing for delivery, shipping it across the Pacific, and selling it in Shanghai for that 4 per ounce premium. Even after paying for shipping, insurance, and financing, they're making serious money on every ounce that moves from west to east. But every ounce that flows from COMEX to Shanghai makes the Western exchange a little more vulnerable. Every delivery notice filed, every bar loaded onto a cargo ship, it's all flowing in one direction. From the paper markets where price is set by algorithms and speculators, to the physical markets where price is set by actual industrial demand. This is creating a feedback loop that's absolutely devastating to the traditional price discovery mechanism. The more silver that flows east, the tighter Western inventories become. The tighter Western inventories become, the more likely we are to see delivery failures or emergency rule changes. And the mere possibility of that happening sends more smart money scrambling to secure physical metal before it's too late. Now, let's talk about why this time is different. Because if you're thinking, didn't we see this before? You're right, but you're also missing the crucial distinction. In 1980, Nelson and William Hunt accumulated massive positions in silver futures contracts. They were essentially betting that they could corner the market through financial leverage. They controlled about 1/3 of the world's deliverable silver supply at the peak. When regulators changed the rules and raised margin requirements, the whole thing collapsed. Silver crashed from $50 an ounce to under $11 in a matter of months. In 2011, we saw another spectacular silver rally. It peaked just under $50 again. But that run was driven by post-financial crisis fears, ETF inflows, and speculative positioning on COMEX. When sentiment shifted and investors started pulling money out of silver ETFs, the price collapsed again. Both of those episodes were primarily driven by Western financial speculation, leverage, sentiment, paper positions that could be unwound as quickly as they were built up. What we're seeing now is fundamentally different. This isn't about a few wealthy individuals trying to corner the market. This is not about Western investors getting nervous about inflation or monetary's largest industrial economy systematically draining global silver inventories to feed its manufacturing base. China now consumes roughly 402 million ounces of silver annually for industrial applications. Solar panels, electric vehicle batteries, electronics, 5G infrastructure. These aren't speculative investments that can be liquidated when sentiment changes. These are real businesses making real products that require real silver. And here's the kicker. China just announced that starting January 1st, 2026, less than a week from now, they're implementing export controls on silver. Companies wanting to export silver from China will need government licenses. Think about the implications of that for a moment. The world's largest silver consumer is about to make it significantly harder for metal to flow back out of the country. At the same time, global industrial demand continues to grow. Solar installations are accelerating. Electric vehicle adoption is exploding. Electronics production shows no signs of slowing down. But here's what really makes this situation unprecedented. The gap between where silver is trading in Eastern physical markets versus Western paper markets is not just a temporary anomaly. It's becoming the new normal. And that gap is telling us something profound about where real price discovery is happening. For decades, the price of silver has been determined primarily in London and New York. The London Bullion Market Association sets the daily fix. COMEX futures contracts provide the marginal pricing. ETFs and large speculative positions drive sentiment and volatility. But what happens when the largest industrial consumers of silver decide they don't trust those pricing mechanisms anymore? What happens when Chinese manufacturers are willing to pay $78 for an ounce of silver, while COMEX says it's only worth $74? It means the center of gravity for silver pricing is shifting from west to east, from paper to physical, from financial speculation to industrial necessity. This shift has profound implications that most analysts are completely missing. When UBS published their silver outlook earlier this year, they projected 38 per ounce for the first quarter of 2026. 38. We are already trading at double that level, and we still have 6 days left in 2025. Those forecasts weren't wrong because the analysts were incompetent. They were wrong because they were built on the assumption that Western financial markets would continue to be the primary driver of silver pricing. They didn't account for the possibility that Chinese industrial demand could become so overwhelming that it would literally pull silver out of Western warehouses, regardless of what paper contracts we're trading for. And that's exactly what we're witnessing right now. The great divorce between paper silver and physical silver, between financial pricing and industrial reality, between what traders think silver is worth and what manufacturers are actually willing to pay for it. This divorce is accelerating because of some very specific mechanics that are playing out in real time. Let me break down exactly how this arbitrage is working and why it's becoming self-reinforcing. Step 1. A trader in London or New York buys silver futures on COMEX at $74 per ounce. That's easy. COMEX has plenty of paper contracts available. Liquidity is good. Transaction costs are minimal. Step 2. Instead of just trading the paper, this trader stands for delivery. They actually want the physical metal. COMEX has to deliver actual silver bars from their registered inventory. Step 3. Those silver bars get loaded onto a cargo ship and sent to Shanghai. Shipping costs may be 50 cents per ounce. Insurance adds another 20 cents. Financing for the 30-day transit adds maybe 15 cents. Step 4. The bars arrive in Shanghai and get sold into the physical market at $78 per ounce. After all costs, the trader nets roughly $3 per ounce in profit. Now, $3 per ounce might not sound like much, but when you're moving thousands of ounces at a time, when you can repeat this process month after month, when there's virtually no market risk because you're buying and selling simultaneously, this becomes incredibly attractive. But here's the problem. Every time this arbitrage trade gets executed, it makes the next one a little bit more profitable. Why? Because it removes physical silver from Western inventories while adding to demand in Eastern markets. COMEX registered inventories are already down to historically low levels. When more silver gets pulled through delivery notices, those inventories get even tighter. Meanwhile, Chinese demand isn't going anywhere. Solar panel production isn't slowing down. Electric vehicle manufacturing continues to accelerate. This creates a virtuous cycle for the arbitrage traders and a vicious cycle for anyone short silver in Western markets. The more metal that flows east, the higher the premium in Shanghai becomes. The higher the Shanghai premium becomes, the more profitable the arbitrage trade becomes. The more profitable the arbitrage becomes, the more traders want to participate. Eventually, you reach a point where Western exchanges simply can't source enough physical metal to satisfy delivery demands at current price levels. That's when things get really interesting. That's when exchanges start changing rules, raising margins, or implementing delivery restrictions. And we might be closer to that point than most people realize. The COMEX situation is particularly precarious because the exchange operates on a fractional reserve basis. They maintain relatively small amounts of physical silver compared to the total number of paper contracts outstanding. That system works fine when most traders are just speculating and don't want delivery. But when industrial users start demanding physical metal in size, when arbitrage traders start pulling metal out of warehouses systematically, the math stops working. Look at what happened in December alone. More than 60% of COMEX registered silver stocks were claimed through delivery notices in a single month. If that pace continues, if demand for physical delivery keeps accelerating, if the Shanghai premium keeps widening, COMEX could face a genuine supply crisis in the first quarter of 2026. Now, exchanges have ways to deal with supply crises. They can raise margin requirements to discourage speculation. They can implement delivery restrictions to preserve existing inventories. They can change contract specifications to make delivery more difficult. They've done all of these things before during previous commodity squeezes. But here's what makes the current situation different. Previous squeezes were driven by speculative excess that could be regulated away. This squeeze is being driven by legitimate industrial demand that can't be regulated away. You can't tell solar panel manufacturers to stop using silver. You can't tell electronics companies to find substitute materials overnight. You can't tell Chinese factories to reduce production because Western exchanges are running low on inventory. The industrial demand is real, it's growing, and it's not going to disappear just because financial markets get uncomfortable with the supply situation. Which brings us to China's export restrictions. Starting January 1st, Chinese companies need government licenses to export silver. This isn't just a regulatory formality. This is China saying that silver has become too strategically important to allow unrestricted exports. Think about what this means in practical terms. Chinese silver miners produce roughly 4,000 tons of silver annually. If even half of that production stays in the domestic market to support local manufacturing, that's 2,000 tons per year that's no longer available to global markets. 2,000 tons might not sound like much, but in the context of global silver supply-demand dynamics, it's enormous. Total global silver production is only about 25,000 tons annually. Industrial demand already consumes over 13,000 tons. If China restricts exports by 2,000 tons, while global industrial demand continues growing, you're looking at a supply deficit that can only be filled by draining existing inventories. But as we've already established, existing inventories are already being drained at unprecedented rates. Shanghai stocks hitting 10-year lows. COMEX registered inventories depleted by delivery activity. London Metal Exchange warehouses showing persistent tightness. So where does the additional silver come from to meet growing industrial demand if Chinese exports are restricted and Western inventories are already depleted? The answer is simple. It comes from higher prices, much higher prices. When supply is genuinely constrained and demand is genuinely inelastic, price becomes the only mechanism for balancing markets. And in the case of silver, we might be looking at price levels that would have seemed impossible just months ago. Some technical analysts are projecting measured moves toward 120 per ounce based on the magnitude of the current breakout. Others are talking about $150 if this develops into a genuine parabolic blow-off scenario. Those numbers sound crazy until you consider the mathematical reality of the supply-demand imbalance. If global industrial demand grows by just 10% annually, if Chinese export restrictions remove 2,000 tons from global markets, if Western inventory depletion continues at current rates, if investment demand awakens to the supply crisis, you could easily see scenarios where silver needs to trade at triple digits just to ration available supply among competing users. And here's the beautiful thing about this setup from an investment perspective. Unlike the Hunt brothers' manipulation in 1980, unlike the speculative excess of 2011, this squeeze is being driven by genuine economic fundamentals that can't be regulated away or unwound through sentiment changes. Solar panel manufacturers need silver regardless of what financial markets think about inflation or monetary policy. Electric vehicle producers need silver regardless of what happens to speculative positioning on COMEX. Chinese factories need silver regardless of what Western central banks do with interest rates. This industrial demand provides a floor under silver prices that didn't exist during previous bull markets. Even if investment demand disappears, even if speculators abandon precious metals, even if central banks reverse course on monetary policy, the industrial users will still be there, still competing for available supply, still willing to pay whatever price is necessary to secure the metal they need for production. But let's talk about what could accelerate this move even further. Because the Shanghai premium and Chinese export restrictions are just the beginning of the story. The real catalyst comes when Western institutional investors finally wake up to what's happening, when pension funds start allocating to silver as a strategic commodity, when sovereign wealth funds start treating silver like they treat oil or gas reserves, when hedge funds start buying physical silver instead of just trading paper contracts. Right now, investment demand for silver is minimal compared to historical levels. Silver ETFs hold roughly 600 million ounces globally. That sounds like a lot until you realize it represents only about 2 years of global industrial consumption. And unlike industrial demand, investment demand can change dramatically based on market sentiment and institutional allocation decisions. If just 1% of global investment portfolios decided to include silver exposure, if institutions started treating silver like a strategic commodity rather than just a precious metal, if retail investors discovered the supply crisis story before it becomes mainstream, you could see investment demand surge by hundreds of millions of ounces almost overnight. The mathematical reality is sobering. Total above-ground silver inventories might be insufficient to meet combined industrial and investment demand if both continue growing at current rates. Exchange inventories represent a tiny fraction of annual industrial consumption. ETF holdings could be overwhelmed by sustained institutional buying. Even sovereign silver reserves are small compared to potential demand surges. This sets up what could be the most dramatic commodity repricing event in modern history, not because of speculation or manipulation, but because of genuine supply-demand fundamentals that most investors don't understand yet. The early warning signals are everywhere. Shanghai premiums widening, exchange inventories depleting, export restrictions from producing countries, delivery activity accelerating, arbitrage traders systematically draining Western warehouses. But the mainstream investment community is still treating this like a normal precious metals rally, still expecting traditional mean reversion, still using historical price models that don't account for the industrial demand transformation. That disconnect between market reality and investor perception creates an enormous opportunity for those who understand what is actually happening. Individual investors who position ahead of institutional recognition, retail buyers who secure physical silver before supply chains break down, traders who buy the dips before the dips stop coming. The window for positioning at these levels is closing rapidly. Every day that passes, every dollar that the Shanghai premium widens, every ton that gets pulled out of Western warehouses, it all points to the same inevitable conclusion. Silver is repricing from a precious metal to a critical industrial commodity. And that repricing is happening right now. But here's what makes this opportunity so compelling for individual investors. While institutions debate allocation percentages and conduct 6-month due diligence processes, while sovereign wealth funds hire commodity specialists and form investment committees, while pension funds argue about fiduciary responsibility and risk management, you can act immediately. The strategies are straightforward, but the implementation requires understanding the different ways to gain exposure to what could be the greatest commodity squeeze of our lifetime. Physical silver represents the purest play on the supply crisis. When you buy coins, bars, or allocated storage, you're literally participating in the same demand that's driving those Shanghai premiums. You're removing metal from the available supply pool. You're contributing to the inventory drain that's making Western exchanges nervous. But physical ownership comes with practical considerations. Storage costs, insurance requirements, liquidity constraints when you want to sell, transaction spreads that can be significant on smaller purchases. These factors don't negate the strategy, but they need to be factored into your decision-making. Silver ETFs, like SLV, provide liquid exposure without storage headaches. You can buy and sell during market hours. Transaction costs are minimal. Position sizing is flexible, but you're introducing counterparty risk at exactly the moment when that risk might be highest. If the ETF can't source physical metal to back new shares, if redemption demands overwhelm available inventory, if the underlying supply crisis affects the ETF's ability to function normally, paper claims might not be worth the same as physical metal. Silver mining stocks offer leveraged exposure to what could be multi-year price appreciation. Companies like First Majestic Silver, Pan American Silver, Hecla Mining, they're sitting on reserves that become exponentially more valuable as silver prices rise. When silver moves up 50%, quality mining companies can easily move up 100% to 150%. But you're introducing operational risks, management risks, and general equity market risks that don't exist with direct silver exposure. The sophisticated approach combines all three strategies based on your risk tolerance and investment timeline. A core position in physical silver for direct participation in the supply squeeze. ETF positions for tactical trading around major price movements. Mining stock positions for leveraged exposure during the most explosive phases. But the allocation percentages depend on your assessment of how this situation develops over the coming months. If you believe the Shanghai premium continues widening, if you think Chinese export restrictions genuinely constrain global supply, if you expect COMEX delivery problems in the first quarter, then direct physical exposure becomes more important than paper alternatives. The timing element is absolutely critical because the situation is evolving in real time. Chinese export controls start in 6 days. COMEX delivery activity is accelerating into year-end. Shanghai inventories are draining at unprecedented rates. Investment demand is still minimal compared to historical levels. Every week you wait, every month you delay, you're potentially missing price appreciation that may never be available again at these levels. When institutional money finally recognizes the supply crisis, when retail investors discover the Shanghai premium story, when mainstream media starts covering the inventory drain, the easy money will be gone. Think about the mathematical progression. If silver moves from $75 to $100 over the next 6 months, that's a 30% gain. If it moves from $100 to $150 over the following 6 months, that's another 50% gain. Compound those returns, factor in potential mining stock leverage, consider the possibility of even higher price targets. You're looking at the kind of wealth creation opportunities that only emerge during major commodity cycles. But this isn't just about investment returns. This is about positioning for a fundamental shift in global resource allocation. Countries that secure silver supplies will have technological advantages in solar energy, electric vehicles, and electronics manufacturing. Companies that lock in long-term silver access will dominate their industries. Investors who understand the supply crisis early could participate in generational wealth creation. The geopolitical implications are equally profound. When China restricts silver exports while simultaneously draining Western inventories through arbitrage, when Russia adds thousands of tons to strategic reserves, when developed nations realize they've become dependent on unreliable supply chains for critical materials, silver becomes more than just a commodity investment. It becomes a strategic hedge against resource nationalism and supply chain disruption. This is why central banks are quietly accumulating precious metals, why sovereign wealth funds are increasing commodity allocations, why institutional investors are starting to treat critical materials like they treat energy reserves. They understand that resource scarcity is becoming a defining feature of the global economy. But individual investors still have timing advantages that institutions can't match. You can make allocation decisions immediately. You can adjust position sizes based on developing information. You can take physical delivery without committee approvals or regulatory constraints. You can respond to market developments in real time rather than waiting for institutional processes to play out. The risk management framework is equally important. Silver's industrial demand provides fundamental support that didn't exist during previous precious metals bubbles. Even if investment sentiment reverses, even if financial markets become hostile to commodities, even if monetary policy changes dramatically, factories will still need silver for production. Manufacturers will still compete for available supplies. Industrial users will still pay whatever prices are necessary to secure critical materials. This industrial floor creates a fundamentally different risk profile compared to purely financial assets. Unlike tech stocks that can lose 80% of their value based on sentiment changes, unlike bonds that can be destroyed by unexpected inflation, unlike currencies that can be debased by central bank policies, silver has intrinsic utility that provides downside protection. But the upside potential is what makes this opportunity truly exceptional. If global industrial demand continues growing at double-digit rates, if Chinese export restrictions prove effective, if Western inventory depletion accelerates, if investment demand awakens to supply realities, current prices could represent the early stages of a multi-decade bull market. Technical analysts are projecting measured moves that would take silver well above $100 per ounce. Fundamental analysts are highlighting supply-demand imbalances that could support even higher price levels. Momentum indicators suggest this rally has much further to run before showing signs of exhaustion. The confluence of factors couldn't be more bullish. monetary policy supporting commodity investments, geopolitical tensions driving safe haven demand, industrial transformation creating unprecedented silver consumption, supply constraints limiting production response, investment allocation still minimal compared to potential demand. When all of these forces align, when supply-demand fundamentals are reinforced by monetary policy and geopolitical developments, when technical momentum confirms fundamental analysis, you get the kind of investment opportunities that define careers and create lasting wealth. So here's the bottom line. We're witnessing the transformation of silver from a traditional precious metal into the most critical industrial commodity for the technological economy. The Shanghai premium is just the beginning of a repricing that could continue for years. Chinese export restrictions will only accelerate the supply crisis. Western exchange inventories are already stretched to breaking points. The choice is yours. You can wait for more institutional validation, more media coverage, more obvious confirmation that the supply crisis is real. But by then, silver could be trading at prices that make today's levels look like the bargain of the decade. Or you can position now while the opportunity is still being debated rather than universally accepted, while individual investors still have timing advantages over institutions, while physical silver is still available at reasonable premiums to spot prices. The biggest commodity moves happen when the fundamentals are obvious to those paying attention, but still invisible to mainstream investors. We're in that sweet spot right now. Industrial demand is accelerating. Supply constraints are tightening. Price discovery is shifting from west to east. But most investors are still treating this like a normal precious metals rally. That disconnect won't last forever. When it resolves, when institutional money finally recognizes what's happening, when retail investors discover the supply crisis story, when mainstream media starts covering the Shanghai premium, the easy money will be gone. So let me ask you this. When industrial demand is consuming over half of annual silver production and growing exponentially, when major producing countries are restricting exports to protect domestic supplies, when exchange inventories are being drained by delivery activity, when Shanghai is paying $4 more per ounce than Western markets, how high could prices go if investment demand suddenly awakens to these realities? Are you positioning for this transformation? Are you treating silver like the strategic commodity it's becoming? Or are you waiting for confirmation that might come too late? If this analysis helped you understand why silver is repricing from a precious metal to an industrial necessity, if it showed you why the Shanghai premium signals a fundamental shift in global supply chains, if it opened your eyes to the investment opportunity developing in real time, make sure to subscribe to the Gray Ledger. Hit that notification bell. And tell me in the comments, are you buying this supply crisis story, or do you think the rally has gotten ahead of the fundamentals? Disclaimer. This content is for educational and informational purposes only and should not be construed as professional financial advice. All investments carry risk, including the potential loss of principal. Precious metals and commodity investments can be highly volatile and may decline as well as advance. Past performance is not indicative of future results. The information presented is based on publicly available sources and market analysis, but markets can change rapidly and unpredictably. Always consult with qualified financial and tax advisors before making investment decisions. The author may hold positions in the assets discussed.